Hi there, folks. This is Sam Price, and we're here with another episode of Probate Notes. What I have is a very interesting guest. His name is Frank Campbell, and he's going to tell us a lot about life insurance. Hi there, Frank. How are you today?
Sam, I'm fine. It's nice to visit with you. Thank you.
Yeah, thanks for being on the show. What I'd like to do, Frank, is just kind of get an idea of your background and how you got to where you are now.
Well, I spent 30 years with Prudential as a financial advisor. We did insurance and investments and advised people on estate planning issues and worked with their attorneys, their other advisors. Uh, and after a while, I decided it was time to retire and have some fun. So I did. I made a list, 30 things I haven't done in 30 years, and then I started doing them. And 14 months later, I was on number 28. I was having a fine time, but I figured there was a little bit more I could do for people still. And there's a lot of good investment advisors, but insurance isn't understood even by some of the insurance people that are selling it. And I wanted to make it simple and change the rules because not the law, Sam. The rules say 80% of existing life insurance policies are never going to pay a beneficiary. And I think that's a travesty. And I wanted to change the odds from insurance companies 8, beneficiaries 2, to beneficiaries 8, insurance companies 2. And it's not that hard to do. So I started a company to do that for people.
That's really incredible. I think I got to ask the question now. How is it that some insurance policies don't pay out?
Well, there's term insurance and it will run out. Term insurance is actuarially designed to not be there when you die. A 20-year term, but you're going to live 25 years. You just rented the death benefit. But the rest of it, Sam, in my practice as reviewing existing policies, I find that there's just little things that are overlooked that people didn't understand. The difference between a guaranteed policy and a non-guaranteed or conditionally guaranteed policy is the biggest one I see all the time.
Well, let's first talk about term insurance. I
Okay.
think in my mind I know what that is, but maybe you could shed a little more light on what is term life insurance?
Term life insurance is the least expensive way to purchase a death benefit. Just like renting is normally the least expensive way to have a roof over your head, but it's limited. It goes for a term of years. And in many cases, that's fine. If I know I have 3 kids in college and they're all going to be finished in 8 years, then I can rent term insurance for 8 years and get that obligation done. Once the obligation's gone, so is the need for the insurance. But there's these other long-term needs, people that the wife isn't going to be self-sufficient. She's not going to be financially comfortable whenever you retire. So you buy the permanent insurance for permanent needs and the term insurance for temporary needs.
Let me be sure I have this right. So the
Okay.
purpose behind insurance, if I pass away, I'm no longer earning income. And if my income was supposed to pay for something like my child's education for 4 years, 6 years, however long a kid is in school, for their higher education, then one way to think of insurance is I can rent a term policy for a number of years that if something were to happen to me, that there would still be that payment source to pay for my child's education.
Yes.
That's incredible. I don't think people think of insurance in that way.
Most people don't.
I think most people are playing the gamble game, like to see do I pass first or does my term insurance end first?
Exactly. And a simple example, Sam, though, even after you're retired, let's say you and your wife are on Social Security plus whatever other assets and investments you have. And the number would be like $4,000 a month. Well, that's real money, but nobody looks at the fact that if one of you dies, the survivor doesn't get $4,000 a month anymore. They get the larger of the two, let's say $2,500. So I suddenly lost $1,500 a month, or my wife did, because I'm not here any longer. Most people don't want to take that kind of a cut in their monthly income. The need is still there. Insurance is supposed to replace income. And a policy, even in your 70s or 80s, if you have it paid for, it's going to be there to make up that difference so the spouse can continue on with the same level of financial income and security that they had before.
Okay. So besides term policies, there's a whole bunch of other types of policies. And what are the different flavors available if you don't want to necessarily do a term policy?
Well, they're all under the topic of permanent insurance. I have a permanent need, whatever that is. And so I buy a permanent policy so that whenever I'm gone, that need will be funded. Once you get there, though, that's where the 80% comes in, Sam, because if you have a term policy and you know it's 10 years and you're done, you know that. Permanent policies are two basic types. One is unconditional guarantees that says you pay this premium and we will pay this death benefit when your heart stops, no matter what. That's a little more expensive, but you get a lot more benefit out of it and peace of mind. Most of the policies we see crossing my desk now have conditional guarantees. It sounded really good, but it's if we get this rate of return and if we don't raise our internal charges, then this is going to be fine. But if we don't get that, it's on you. What's that mean? Years ago, one of the big insurance companies decided they weren't making enough money on their charges, so they increased cost. And if let's, for simple sake, let's say you're paying $100 a month, but then it didn't make as much money as it was supposed to. The rate of return was down, or they raised the internal cost by $50 a month. If they went to you and said, Sam, hey, this happened, and now in this review, we find you need to pay $150 a month to have the same degree of certainty that you did before, then you have the ability to make a choice. I don't want to pay it, or I do. But what happens far too often is people don't realize that the policy is going on at $100 a month and it's draining itself. And I see it all the time. People come in with what I call the letter. It says, Dear Sam, you didn't know this. We tried to tell you, but you missed it in the fine print. And your policy is now out of gas. You've been paying $100 a month for 25 years, but there's no cash left. And now, if you want to continue the policy, you have to pay the increased premium. And then it becomes just like that term insurance, Sam. All of a sudden, it's going to be breathtaking what you need to do to keep that policy in place when you're 73 or 83. It's shocking. Hardly anybody rebounds from that.
So we had talked about the insurance company not receiving the rate of return that they had expected. The other issue that you identified was that the costs that the insurance company has to maintain that policy could increase. Can we talk a little bit about how that might affect your policy?
Sure. A clarification, Sam, if it's unconditional guarantee,
Yes,
then the insurance company is taking the risk of not making enough money on their investments.
that's a whole life policy.
Yes. If it's conditional guarantees, it's not what the company earns. It's they have these funds that they set up, and you can select what one you want to invest in. And it sounds like you're going to participate in market growth, but it's limited. And they cap it or they change. There's a few technical things they do. But what it really means is if the stock market goes up 12%, you might only get 8. And that's okay in an up year, but in a down year, you don't get the leverage that you need. And then the policy doesn't perform. But they're going to tell you, the insurance company is going to say, well, it's not what we invested in, it's what you invested in. And so if the investment you picked out or that your agent recommended for you when you purchased the policy doesn't perform the way it was supposed to, it's on you.